Good afternoon and welcome back to the BDO Talking Trusts Information Sessions. This is part 2 of our 4-part series where we host guest speakers who are experts in trust law and taxation and who will share practical information and insights aimed at helping you navigate your duties and responsibilities of being a trustee. I am Ricardo Teixeira, Chief Operating Officer at BDO Wealth Advisors, and I will be your host and facilitator for the Talking Trusts Information Sessions. Thank you for joining the conversation today. And if you are joining the Talking Trust series for the first time, please do look up the recording of part 1, which was the burden of trusteeship, which you can find on BDO's YouTube channel. Today's webinar will also be recorded, and a link to the recording will be shared with you after the event. We have set aside 15 minutes for an interactive Q&A session following the talk. So please line up your questions in the queue during the talk by using the Q&A function on your screen. You'll find this in the top right-hand corner of your screen. Just look for the speech boxes with a question mark. BDO has been providing professional audits and advisory and tax services to families and businesses for over 60 years in South Africa. And there has most certainly always been a focus on trusts. However, of late, both SARS and the Master of the High Court appear to have raised the stakes and the attention to the governance and administration of trusts. Trusts, as we know, are unique structures, and as a result, this attention by SARS and the Master of the High Court has unfortunately revealed many shortcomings and failures by trustees, many of which have had devastating consequences on the original purpose and intent in establishing the trust. With tax reporting season just around the corner, BDO's objective in hosting this information series is to raise your awareness, knowledge, and understanding of the best practice and benchmarks for good governance in the administration of a trust. By knowing what is required and having the right solutions and processes in place, the trust can be extremely beneficial to a family's wealth creation and protection. So today's topic is Back to Basics, Trust Tax 101. With the understanding of the trustee role and responsibilities we established in part 1, today's focus is on the trustee's tax obligations. Our guest speaker is a tax director of BDO South Africa, specializing in individual and trust taxation. She is a professional member of the South African Institute of Tax Practitioners and is registered as a tax practitioner with SARS. Her qualifications include a higher diploma in tax law and a higher diploma in international tax law. With more than 20 years practical experience gathered across private as well as her time at SARS, she is extremely well qualified to summarize the key aspects of tax legislation which are applicable to the taxation of trusts. Please welcome Johnny Howell.
Thank you, Ricardo. Ladies and gentlemen, colleagues, good afternoon. The complexities of tax law and the application of such to trusts, whether a South African registered trust or a foreign trust, does not lend itself to a 30-odd-minute presentation. So my intention today is to highlight the basic tax concepts a trustee should be aware of and the risks associated with getting it wrong. The first webinar of this Talking Trust series, held on the 9th of June and presented by Thea van der Spey, dealt with the role of the trustee, the responsibilities attached to the position of trusteeship as regulated by the Trust Property Control Act and established case law, and in Thea's own words, the burden that comes with this role. This burden for trustees is not only limited to the statutory provisions of the Trust Property Control Act, but also finds itself in the statutory provisions of the Income Tax Act and the Tax Administration Act. Trustees should therefore understand what responsibilities and possible personal liabilities and exposure their trusteeship holds for them, as set out in these various statutes, each having their own provisions. Therefore, our discussion points today are just a quick recap of the role of trustee for Trust Property Control Act purposes. I selected a few which I believe captures the essence of the responsibilities as presented by FIA to remind you of the requirements of the statute, but I do suggest that if you missed the webinar, to obtain the recording. The responsibilities of trustees for income tax purposes and how the concept of trust and trustees have been mangled and worked into the tax law. And then we'll look at what income tax laws are mostly relevant, key focus areas for SARS, and certain pitfalls trustees should be made aware of. And lastly, the consequences of getting it wrong, the numerous sanctions for non-compliance with tax law, the risks for trustees personally, where they fall foul of their fiduciary duty to comply with tax laws, and how to correct such non-compliance. As mentioned for me, the essence of the role of trustee is trustees are the custodians of the assets in the trust and must take care and reasonable steps to ensure that the interests of the trust and the trust beneficiaries are protected at all times. Trustees must act with care, diligence, and skill, which can reasonably be expected of a person who manages the affairs of others. And trustees must exercise an independent discretion and avoid self-serving decisions. From a tax law perspective, a trust bears additional duties and responsibilities, which could have personal liability as well as punitive measures in the form of penalties and interest for the trust fund. But before we delve into the various provisions, it is important to understand the workings of the tax law and how such application to the trust finds application to the trust and the trustee. Lindy, if we could go over to the next slide, please. Thank you. Okay. So how does the tax law find application to the trust and trustee? Various terms are defined in tax law to ensure specific application to such. These may vary from the definitions found in the Property Control Act regulations. The introduction of definitions were required to be able to make a trust liable for South African normal tax. These definitions include a taxpayer, which means a person chargeable with any tax leviable in terms of the Income Tax Act. Now, emphasis placed on the word person. A person is then defined to include specifically a trust. And the meaning of trust includes any trust fund consisting of cash or other assets which are administered and controlled by a person acting in a fiduciary capacity, where such person is appointed under a trust deed. And then, to tie it all in, the definition of trustee includes every person appointed or constituted as such by an act of parties, by a will, by an order or a declaration of court, or operation of law, and includes any person having the administration or control of any property subject to a trust, usufruct or other limited interest, or acting in any fiduciary capacity. Then, just in case the above definitions didn't make it clear that the trustee is a responsible person when it comes to the administration and operation of a trust, the definition of representative taxpayer states that in respect of income which is subject to any trust, the trustee is a representative taxpayer. It is the workings of these provisions which brings a trust into the taxing realm, which puts the trustees at the front and center of SARS. The trustee as representative taxpayer stands in the shoes, literally, of the trust, and through these mechanics could lead the trustees to being held personally liable. Now, to the relevant tax law provisions. Section 7 of the Income Tax Act, known as the Attribution Rules, are anti-avoidance rules aimed at taxing in the hands of the donor, and we'll speak to that concept now, any income which has resulted from a donation or similar disposition. Essentially, Section 7 of the Income Tax Act seeks to tax the person who introduced the assets into the trust on the income which such assets generate. Most inter vivos trusts are created, as you all know, with a settlement by a person, and let's call that person the donor, the settlement of an asset or cash by way of an outright donation or by means of a loan, which is either interest-free or interest-bearing. These methods of settlement, to the extent that such are not at arm's length, will always attract the application of Section 7 in the determination of who's actually to be taxed on the income received by the trust. The term attribution refers to the fact that although the trust might receive the income or capital gains, the trust or the trustees may award such income or capital gains to beneficiaries. The responsibility for the settlement of the actual taxes may fall on another person, in which case the taxes are attributed to such person. For example, if an amount arises in a trust because of a donation or other disposition, and remember an interest-free loan qualifies as an other disposition, made by a parent, and the trustees of a trust award the income to the parent's minor child, then Section 7 deems the income to accrue to the parent and as the donor, and he or she needs to settle the taxes. So essentially, Section 7 allows for three parties to play: the trust, the beneficiaries, or the donor, the person who basically made the donation or low or interest-free loan. The attribution rules are quite complex, but it's important for trustees that they just know where cash or an asset is settled upon a trust by way of a donation or interest or low interest loan, that these rules apply. Then you have Section 25B to the Income Tax Act. This is a principal taxing section of trusts, but again, this will be subject to the provisions of Section 7. Section 25B deals with the taxation of the income, the expenditure and allowances of trusts, and the trust beneficiaries, whether the beneficiaries are of a local trust or a foreign trust. Generally, if income has been awarded by the trustees to the beneficiaries are taxed on the income. Alternatively, the income will be taxed in the trust. However, where Section 7 applies, the donor is taxed instead of the beneficiaries or instead of the trust. The conduit principle applies to trusts. The conduit principle means that the nature or the identity of the income received or the expenses incurred by the trust essentially flows through to the beneficiary, should such income or expenses be awarded to the beneficiary in the same tax year. Where the income is awarded to the beneficiary in the next tax year or future tax years, the identity of the income is lost. And generally, in the case of local trusts, the award of that income will constitute an award of capital. Then we have Section 7C. This is the deemed donation rules and applies to low or interest-free loans made to trusts. My colleague David Warnaker will speak more to this topic in next week's webinar, but just to note that this legislation deems the difference between the SARS official rate and the rate of interest actually charged by a connected person to a trust on the loan made by such connected person to the trust as a donation, and donations tax is chargeable in the hands of the natural person. Lastly, trusts are also liable for capital gains tax on the disposal of any asset. The capital gains tax provisions similarly have anti-avoidance provisions, essentially their own set of attribution rules, which mirror the Section 7 provisions, which we have spoken to. Again, three parties are at play when determining who is responsible for settling the taxes arising from the capital gain, namely the trust, the beneficiaries, or the donor. All other taxes, such as donations tax, dividends tax, and transfer duty, applies to trusts. Just estate duty obviously does not apply. Apart from being liable to so many types of taxes and duties, a trust is a very expensive tax vehicle. Trusts are taxed at the highest tax rate, and do not enjoy the benefit of all of the exemptions or exclusions or rebates which a natural person enjoys. For the 2020 tax year, trusts are taxed on income at a flat rate of 45%. Now compare this to an individual who's taxed at a sliding scale, with income only in excess of 1.5 million being taxed at 45%. No rebates are deductible from the tax liability, save where applicable maybe foreign tax credits. With respect to capital gains, the inclusion rate of a capital gain is 80%. Compared this to an individual's inclusion rate of 40%. So what does that mean? The inclusion rate means that only 80% of the gain is subject to normal tax. And with a flat rate of 45% applicable to trusts, a trust has an effective tax rate for capital gains tax purposes of 36%. Compare this to an individual's effective tax rate of 18%. Furthermore, no annual exclusions are allowed. An individual has an annual exclusion of 40,000 Rand against your taxable capital gain. And furthermore, and very importantly, a trust does not have the primary residence rebate exclusion of up to 2 million Rand, as is the case for an individual. Some key thoughts on focus areas of SARS. The SARS focus areas quickly find their way into tax return disclosure changes, which we see annually with the start of the filing season. On this point, you may have read that the 2020 filing season has undergone some transformation, with SARS introducing 3 phases, the last being the actual submission of tax returns. So a trust tax return can only start being filed on e-filing platform from the 1st of September of this year, with a deadline of 31 January of 2021. This new phased introduction has essentially shortened the filing season by 2 months. Furthermore, other focus areas, based on recent changes to the tax returns that we've seen and from SARS audit inquiries that we have also seen come through, SARS does interrogate the information disclosed with regards to loans received by the trust, so the disclosure on the tax return. This is to check and reconcile whether the required donations tax has in fact been paid. SARS also calls for third-party data to be reconciled on any capital gain or loss, and calls for the trust deed to verify that trustees have acted within the terms of the trust deed when they have awarded assets or income or capital gains. Therefore, it's important to review the trust deed to make sure it allows the trustees to act as intended within the terminology of tax law. As importantly, to ensure that the necessary minutes to meetings and resolutions of decisions are drafted properly, kept on record for the requisite time frame, and resolutions that give effect to the awards are made, and other decisions taken by trustees are also recorded. My other concerns, and I'm sure a lot of trustees share the same concern, remains the Davis Committee's continued focus on trusts. The discussions and thoughts around the change in the conduit principle, the idea to first tax the trust on any income and capital gains before awarding the net amount to beneficiaries, that's been on the minds and the agenda of the Davis Committee for some time now. In my experience, one of the biggest errors trustees make is to wear their tax hat and not necessarily wear the hat of trustee. I always use the hat analogy that at times where there's a disposal of an asset or where income is received by the trust and the trustees want to mitigate the tax cost by awarding such a gain or income to beneficiaries, trustees follow or take the lead from tax instead of maybe worrying about an estate duty perspective or the true intention or the purpose on which a trust was actually found. Trustees, beneficiaries are generally taxed at a lower tax rate than trusts, so one can understand why trustees usually consider making those awards to mitigate the tax cost for everyone. Depending on the purpose of the trust, as held in the trust deed, awarding assets or income of the trust to its beneficiaries could be a direct opposite to the initial purpose. It diminishes the trust capital and makes the capital immediately dutiable for estate duty in the beneficiary's hands. So getting it wrong in terms of the trust deed, merely for the sake of a tax cost or a tax saving, has its consequences. Trusts are taxed at the highest rate of tax, but this high tax cost can be exacerbated should trustees get it wrong from an administrative as well as a compliance perspective. Non-compliance is essentially the failure to comply with an obligation that is imposed by or under a tax act and carries punitive sanctions in the form of penalties and interest. Some of the penalties relevant to trust would include administrative non-compliance penalties. This would include failure to submit a tax return or even update contact and other administrative details with SARS. Often we see dormant trusts not submitting tax returns. It is a requirement to render annual tax returns irrespective of whether income is received or whether the trust holds an asset. We also have underestimation penalties. This is specifically in the case where an error has crept in the provisional tax calculations. And yes, trusts do qualify as a provisional taxpayer and should therefore render provisional tax returns annually, 2 provisional tax returns essentially. Other penalties are penalties for the late or non-payment. Again, in the case of provisional tax estimate calculation errors. If a trustee, for instance, does not render a provisional tax return, and SARS's estimate of taxable income results in a tax liability, SARS would accept its taxable income as the final estimate. And if the trustees don't submit a return opposing this amount, SARS will levy penalties and interest for the non-payment of its calculated amount. Understatement penalties are penalties for any default, and which can go up to 200%. An understatement means any prejudice to SARS or the fiscus as a result of a default. And default really includes any failure to submit a return, an omission or an incorrect statement in a return, and the failure to pay the correct amount of tax. And finally, SARS also charges interest on any of these outstanding taxes. The current rate is 9.75% per annum. So save for the understatement penalties perhaps, you can see that these penalties can easily be avoided through disciplined administration and good governance by trustees, just meeting the required deadlines and attending to SARS request for information. It's as simple as that. Clearly, it's not worth the cost in penalties and interest for getting it wrong. As I mentioned, the trustee, as the representative taxpayer, is a responsible and accountable person for the actions of the trust and will be personally liable for the tax payable if, where the taxes remain unpaid, the trustee has alienated or disposed of any of the amounts in respect of which the tax is so chargeable, or disposes of or parts of the funds or monies which are in his or her possession, if the tax could legally have been paid out of these funds or monies. Furthermore, if a trustee acts in a way which is non-compliant with the tax laws, it could be seen as a criminal offence. A criminal offence is one where is an act where one willfully and without just cause fails or neglects to and I've just taken a few that could be relevant. Register or notify SARS of a change in registered particulars. Appoint a representative taxpayer or notify SARS of the appointment or change in representative taxpayer. As simple as the non-submission of a return or document to SARS, or to retain records as required. Such a person is guilty of an offence and upon conviction is subject to a fine or even to imprisonment for a period not exceeding 2 years. And SARS may in certain circumstances name and shame such persons. Clearly, it's not worth the professional and reputational risk for trustees of having a criminal record for getting it wrong. Fortunately, trustees are able to remedy non-compliance. But firstly, one needs to understand what the non-compliance is. And this is done by either contacting SARS or applying for a tax clearance certificate for good standing. Then one needs to file all the outstanding returns and settle all the tax liabilities. But where there are cash flow problems, one can approach SARS to arrange installment payment arrangements. Trustees also have the opportunity of remedying non-compliance through the voluntary disclosure program. But once the non-compliance is remedied, trustees need to maintain the compliance status. And this is done through robust administrative processes and strict adherence to tax and other statutory requirements. Trustees can ensure by doing this, compliance status will be maintained. The taxation of trusts and the taxation of beneficiaries is complex because SARS continues to pass legislation in an attempt to close loopholes upon loopholes upon loopholes. So the applicable sections are literally scattered right across the Tax Act. It's not easy to follow all the sections and to keep up to date with the many changes. The cost to the trust for any non-compliance in the form of penalties and interest could be material amounts. The personal and reputational cost to trustees, even more significant. The role and responsibilities of trustees for tax purposes is indeed a burden, but it's our job at BDO, with our specialized knowledge and practical experience, to guide trustees on their responsibilities, whether it be on the administration of trusts or the taxation of such, and to provide you with the necessary sound advice. Thank you.
Thank you, Donna. Thank you for that enlightening talk. I think succinct, you did very well to, I think, achieve the ground that you covered in 30 minutes. So thank you for doing that.
Pleasure.
I see there's a couple of questions coming through. So I'd just like to encourage everyone that's on the call to please share your thoughts. Just publish a question under the Q&A and we will take it. We've got time now. So I'll facilitate that with you, Donna, if that's okay.
Perfect, thank you.
Great. So if a question that's come through from Anonymous was that if funds are of a capital nature, does it retain its composition regardless or not of being declared to an individual within a particular tax year?
So again, I think the biggest concern is these terms, capital for income tax purposes versus capital from maybe if one reads the old trust deed. Trust deeds really make reference to income and capital beneficiaries. The capital idea in a trust deed, many of which are established on templates that were introduced way before capital gains tax, makes reference to the corpus of a trust. So the founding capital and then the accumulated capital and once taxed, almost like post-tax capital in a trust, where capital from an income tax perspective can sometimes be sort of blurred and confused with capital gains tax. But capital gains tax is essentially income. So if you have a beneficiary that's an income beneficiary in terms of the trust deed, then an award of a capital gain or an award of rental income or interest would qualify under for distribution to that income beneficiary. a capital beneficiary is then post-taxed or post-tax income or the corpus funds of the trust.
Okay, thank you, Donna. So it does get, I mean, it can be quite blurred in terms of the tax definitions as well as how one deals with it within the accounting records of the trust.
100%, yeah. And that's very clear, and I'm sure Professor David Warnaker will speak to it, with the introduction of that section 7C, this deemed donation on loans made to trusts, where there was a play on the word beneficiaries loan account. And for many, many years, the accounting, our accounting teams and the accounting professionals out there made reference to any funds held in the trust that were actually that of a beneficiary through either awards of income or and so forth. SARS then considered those as loans, which were subject to or are subject to the provisions of Section 7C. And actually, in fact, they specifically excluded from that provision. So definitely one needs to be very careful and mindful of accounting terms and tax terms.
That's right, yeah, okay. And I'm just going to publish another question that was linked to that, which I think you've answered, Danae, and that's really the fact that it does become blurred. And I suppose the point is one of keeping the records correctly and administering the trust. If that is done correctly, then making the disclosure to SARS can be so much easier.
Correct, and we've found it in practice, Ricardo, that SARS does call for, as soon as you submit a tax return, they do ask for supporting documents in the sense of the trust deed, the letter of authority, resolutions to the decisions made. And if trustees have their house in order, which I know is difficult at times because there's just so much volume of information in today's time, but if your house isn't in order, then SARS has a means of challenging the accuracy of such, and you don't want to give SARS an opportunity to start questioning or prying into anyone's affairs.
That's absolutely right. Danae, you mentioned that trusts are provisional taxpayers. The question that we received, excluding PBOs, can a trust apply for being a non-provisional taxpayer?
You know, SARS's policy and practice sometimes never lends itself to the, or at times, I should rather say, not never. At times, it doesn't lend itself to the tax law. Tax law is very clear. A trust, irrespective of whether it's dormant or not, qualifies as a provisional taxpayer. But with the e-filing system, which is the electronic platform that SARS has utilized for many years, and which is a fantastic means of submission. I'm still of the old school where we started with actual manual submissions to SARS. So this e-filing platform then actually allows a person where you don't have any taxable income, as an example, an individual that doesn't earn interest for the year, then not to render a provisional tax return, and there wouldn't be any penalties imposed for that non-submission of the provisional return. However, I'm quite fond of legislation over practice, so I would suggest to any trustee and any tax practitioner out there, rather file those provisional tax forms, rather file the null dormant income tax returns, because that's in terms of the Act, and that will be, with that basis and with that backing, you can't be wrong.
That's good advice. Thank you, Danae.
Sure.
Danae, another question linking to the income and capital within a trust. The question is, if there is a resolution in place to award income and capital for the year, will Section 7 still be applicable?
Yes, so Section
Okay.
7 being the attribution rules. Yeah, Section 7, and give me a day to explain that because there's so many attribution rules. It's not just one, it's quite a few, couple of pages in the Tax Act.
Absolutely.
But it's all dependent on whether there is this element of a donation made by someone, and that is the cause of income received by the trust. And if the donor is still alive, 10 to 1, the donor will be taxed, irrespective of whether the trustees have utilized or acted on the authority and distributed such to a beneficiary. So the overriding provision is you first have to see if there isn't a donor that triggers or is accountable and responsible for the tax. If not, then generally the beneficiary and otherwise the trust. But each case on its own merits.
Okay, thank you, Donna. I see there's a very interesting question here, which I think is quite relevant in our experience at BDO, and as you and I have shared before, is that the tax non-compliance within trusts is quite high. Very few trusts have, or very, very many trusts have not been compliant. The question we've received here is, how do you fix trusts back years tax compliance in cases where beneficiary details are not available anymore, like ID numbers of beneficiaries? Interesting. Your views, Donna?
Sure. With difficulty, but
is the liability back to the previous trustees or is it to the current trustees?
I think you'd find it very difficult to break current trustees' liability, and I suppose FIA would be best placed to sort of answer who's really responsible. But I suppose the person now in the control of the trusts, people will look to that person to make sure that the trust is compliant. Irrespective of whether there were 3 or 4 preceding trustees. But fortunately, one is able to approach SARS, and I think that's to a large extent where either the voluntary disclosure program comes in if there was an incorrect disclosure, but if there wasn't prior year's disclosure, then I think you still have the opportunity to reach out to SARS to say, this is basically the best that we can do, and you've got to prove to SARS that it is your best, that you've tried to track this or you tried to place this, etc., etc. And then SARS can actually agree that they will make assessment on this, call it an estimate basis. But this is sort of working hand in hand with SARS. But yeah, the tax returns from date of inception to today would have to be filed, completed and filed before a trust is compliant.
Okay, so golden rule, just keep the trust tax affairs up to date from day one.
Yes, yes.
Renee, another question linking again back to sort of the conversation earlier around the nature of income in a trust or retained trust funds. Is undistributed dividend income by the trust at risk of being viewed as normal income if the distribution takes place several years later?
No. And now there are new sets of rules that will be applicable to beneficiaries of foreign trusts, but local trusts receiving local dividends, the nature would never change.
Absolutely. Good. Thank you for clarifying. Shifting the conversation to the hats of a trustee as a taxpayer, as well as being a taxpayer in their own capacity. So in the event that you have another question disappeared. Okay. Sorry. The question is that in the event that a director is a trustee is a director, and the company is owned by the trust, will the director be liable for tax in their own hands or in the hands of the trust, is the question.
Sorry, just repeat the...
Okay, I'll repeat the question. If a trustee is a director of a company which is owned by the trust, is he taxed in his personal capacity or through the trust? So if a trustee owns shares in a company, what are the tax implications there? So it seems to be a question really trying to clarify the roles of trustee versus director, and is there independence between those two roles when they are actually the same person and there's a common shareholding in the trust?
I'd have to pass on that question if you don't mind. We'll look at it more closely. I'll have to draw a few pictures to completely understand. So if you don't mind, we'll take it offline and revert back to the
Lisa, I'll
person
get
who
back
asked
to you.
it.
Yeah, Lisa, Danae, and I will get back to you on that. Thank you for the question. I think that's
Sure.
a good question. If I can just pick up over here on another question, Danae, we've often found in our experience that often trust tax affairs are not kept up to date, but often the beneficiaries submit tax returns. What can go wrong here?
What can't go wrong here is actually the question. No, and that's a difficulty. And our advice is always you cannot submit a tax return if you're a beneficiary in a trust, and historically there have been awards made to you, because remember, a trust return is a declaration that you as taxpayer make. It's a solemn declaration. It's a promise that what you've put into the return is full and complete. And the words full and complete are actually in tax law. So you can't go ahead and submit your tax return saying it's full and complete when you know that the awards haven't been finalized by the trustees and haven't haven't come through, and you haven't reflected it in your tax return. So yeah, our advice to beneficiaries is that they unfortunately have to hold back with their own submission until the financial statements, the resolutions, all sorts have been done on the trust side.
Right. Thank you, Danae.
Sure.
Question from Anonymous. If a trust accountant can't be traced and financials need to be submitted by another accountant that is temporarily assisting, do the trustees need to register that accountant with SARS?
No, remember, an accountant is a clever person and does provide a very good service, tongue-in-cheek. No, but remember, the accountant is separate to a representative taxpayer. A representative taxpayer is what you have to notify SARS of, and the representative taxpayer in the case of a trust is the trustee. So an appointment of a new accountant shouldn't have any effect, or SARS doesn't need to know.
Correct. That's right. Okay. It's just really the administration around notifying the Master of the High Court around the appointment of a new accountant, but not a SARS issue.
Yep, wouldn't be a SARS issue.
Sure. And then, Danae, can certain income beneficiaries have preferential right to income over other income beneficiaries? Not sure if that's a tax question or more a structure of the trust deed, I'm assuming.
Yeah, I would also imagine that a trust deed would have to be specific to that extent. But at the end of the day, do remember that the different trusts that we have is either a inter vivos discretionary trust, where trustees have the discretion, and again confirmed by the trust deed, and their discretion, however they want to apply the income or the capital of a trust, where other trusts are vesting trusts, which the trust deed is basically, or it already sets out that the assets belong to a specific beneficiary, and that the trustees are merely administering those assets for that specific beneficiary. So again, I think it's to the trust deed whether it lends itself to that sort of arrangement.
Mm-hmm. Today we're going to take one question, then we'll end. And this is a common challenge that we find with in the administration of trusts, is that often a primary residence is owned within a trust. The question here is, what will the tax implications be in the event that the property is awarded to the beneficiary in order to deregister the trust? And this is a primary residence.
Okay. So to an earlier slide that we had, unfortunately, a trust does not enjoy the benefit of the 2 million rand primary residence abatement. What that essentially means is that where a person sells the primary residence, and for example the value was 10, or the proceeds is 10 and the cost was 6, you've got a 4 million rand profit or gain. In an individual's case, you can knock off an extra 2 million or off that and only be taxed on the remaining 2 million. A trust does not have that benefit, purely because a trust isn't seen as a natural person and can therefore not have a primary residence. So if a trust does award the actual property, or if it sells the property and awards the gain to the beneficiaries, then unfortunately the beneficiary, or in calculating that capital gain, because remember, even an award of the property to the beneficiaries is a disposal for capital gains tax legislation purposes. So one needs to do the calculation there. And from that calculation, there wouldn't be the 2 million abatement. So the trust, or if the trust distributes the capital gain on that transaction to the beneficiaries, you would suffer the full capital gain without the benefit of the 2 million abatement. Okay,
all right. And I think that if you just close there, Danae, thank you very much. I think that demonstrates the complexity that is evident in the taxation of trusts, as well as how important it is to actually plan in advance and making sure that the purpose of the trust is well achieved by actually taking into account the forward planning. And just looking at the complexity around tax that you've shared with us today, I think that's very evident. So thank you very much, Danae, for your input. It's been very valuable and we appreciate the engagement. There's been a number of questions which we have not answered, but what we will do is we will circulate a Q&A during the course of next week, which will detail all the questions that we've received, as well as an answer from Danae and from BDO. So thank you, Danae, for joining us. And thank you, everyone, for joining today's conversation. This webinar was recorded, and a link to the recording will be shared with you later this week. Our next edition of Talking Trusts will be hosted on 9 July, 2:30 p.m. And the topic is tax planning opportunities for trusts. That will be presented by Professor David Warnicker. And whether it's establishing a new trust or structuring the affairs and transactions of an existing trust, the choice of structure, setup, as well as knowing the tax opportunities available can be very useful in achieving the best outcome in the long term. So if you have not already, please do RSVP and join us on 9 July. And in the interim, if you have any questions relating to the administration of trusts, please do reach out to BDO and we will be glad to help you get to the right solution. Stay well, stay safe, till we connect again. Goodbye.